This was a week of conflicting signals for advanced micro devices. The company locked in major AI infrastructure deals with giants like OpenAI and Oracle, fueling a rally to new highs. But the week ended on a sour note, with the stock tumbling nearly 7% on rumors of a key product delay. This raises the question for investors. Was this week's dip a momentary blip in a massive growth story, or a warning shot about the challenges of competing in the AI arms race? Welcome to TickerWatch News for Advanced Micro Devices, Week 5, 2026. This episode will break down the pivotal news and market developments for the company, from major partnership validations to late-week volatility that has the market talking. Stock Snapshot. It was a turbulent week for advanced micro devices. After a strong start that extended a 7-day winning streak, the stock closed the week down significantly. It ended Friday's session at $236.73, a decline of roughly 6% for the week. The drop was sharper than the broader market, which also faced headwinds from growing uncertainty in the tech sector. This volatility erased some of the stock's impressive year-to-date gains, pulling it back from recent 52-week highs and setting the stage for a critical earnings report next week. Top news and headlines. The biggest news items for the company this week painted a picture of both immense opportunity and significant execution risk. First, the company's role in the AI build-out was validated by several key customers. Oracle announced plans to raise up to $50 billion in 2026 to expand its cloud capacity, specifically naming advanced micro devices as one of the major customers driving this demand. In an even bigger headline, the company landed a multi-year chip deal with OpenAI. The agreement will supply the AI leader with graphics processing units and includes a warrant that could allow OpenAI to acquire a stake in the company if certain milestones are met. These partnerships solidify the company's position as a credible alternative to NVIDIA for powering large-scale AI systems. Second, rumors of production delays hit the stock hard at the end of the week. Reports surfaced on Friday claiming that the company's upcoming MI450 AI accelerators were behind schedule. This news prompted a roughly 6% drop in the share price, sparking concerns about the company's ability to keep pace with demand. However, analysts at Wells Fargo quickly countered the report, stating their research showed production remains on track. The firm maintained its overweight rating and suggested the sell-off might represent a buying opportunity. Finally, the company continued to strengthen its ecosystem in leadership. It expanded a partnership with Gigabyte to push on device AI for laptops and other hardware. It also announced a collaboration with Tata Consulting Services to develop AI solutions for enterprise clients. Adding to the news, the company appointed former Accenture Chief Financial Officer K.C. McClure to its board of directors, a move seen as strengthening its financial oversight during a period of intense competition and capital investment. Market reaction and investor sentiment. Wall Street sentiment remains largely bullish on advanced micro devices despite the late-week sell-off. In the face of the delay rumors, Wells Fargo reiterated its overweight rating in a $345 price target. Other analysts also grew more positive. Piper Sandler raised its price target to $300, citing the ramp-up of the company's Helios AI platform and the new OpenAI contract as major tailwinds. KeyBank reiterated its overweight rating with a $270 target, pointing to what it calls strong momentum in server CPU demand. And Bernstein raised its target to $225. The overall narrative from the market is one of strong growth potential, particularly in the data center. Analysts widely believe the company is gaining market share from competitor Intel, whose own reports mentioned internal supply constraints. The news of being a key supplier for Oracle's and OpenAI's AI infrastructure buildouts further fueled this bullish narrative. The primary risk highlighted by the week's events is execution as the company scales production to meet the massive demand for its AI chips. Technical and fundamental check-in. From a technical perspective, the stock was showing strong momentum, riding a 7-day winning streak early in the week and trading near its 52-week high. The sharp pullback on Friday brought the price down to around the $236 level, which will now be a key area of support for investors to watch. The prior highs, near $264, represent the next major resistance level. On the fundamental side, valuation remains a key topic of discussion. With a forward price-to-earnings ratio in the 40s, the stock isn't considered cheap. However, many analysts argue this premium is justified by the company's aggressive growth projections. Management has guided for data center AI revenue to grow at a compound annual rate of over 80% in the next few years. This week's news reinforced that long-term growth story, with the Oracle and OpenAI deals providing tangible evidence of demand. The rumored production delay, however, serves as a reminder of the risks tied to that growth. What to watch next week? All eyes will be on the company's quarterly earnings report, scheduled for release after the market closes on Tuesday, February 3, 2026. Analysts are expecting revenue of approximately $9.7 billion, which would be a year-over-year increase of about 26%. Adjusted earnings are forecast to be around $1.32 per share. Beyond the headline numbers, investors will be listening for any updates on the production and sales ramp of the MI300 and MI400 series of AI accelerators. Any commentary addressing the rumored MI450 delays will be critical. The bull case for next week involves a strong earnings beat coupled with optimistic guidance for 2026 that confirms the AI growth story is fully intact. A bear case would be any miss on revenue or earnings, or guidance that suggests production challenges or slowing demand. Given the stock's high valuation, even in-line results could lead to further volatility. Thank you for tuning in. This podcast is for educational purposes only and does not constitute financial advice. Be sure to subscribe, leave a review, and share this episode.